All right, thank you very much for including this paper in the program. It's a great pleasure to be part of this conference. This is a joint work with Dimitri, Vayanos, and Paul Wooley, both at the London School of Economics. So let me motivate this work by emphasizing two key aspects of the asset management industry. So first of all, most of the wealth that is nowadays invested in financial assets, in financial market, is managed by professional investors. For instance, in 2007, only about 20% of the US stocks were actually held directly by individual investors. And to put this number in perspective, in the early 80s, this figure was about 50%. So this is definitely a large and growing industry. Now, the second important aspect about this industry is these asset managers' risk and return. So in general, their performance is very often measured against some benchmark. So this could be explicit through their compensation contract or implicit through fund flows. So therefore, given this picture, we believe that it's important to provide some answer to the following questions. So we would like to study how the delegation of asset management affect, in general, equilibrium prices. And more in particular, we want to understand the consequences, the implications of benchmarking. So what do we do in this paper? So in this paper, we study the joint determination of asset management contract and equilibrium prices. What this means is that prices will clear the market given the contracts, but at the same time, the contracts are not taken as exogenous as done in the current literature, in most of the current literature, but they will be optimal within some class of contract given the prices. Now, why is it important to endogenize contracts and prices within a unified setting? Well, I'm going to argue and try to convince you that this will give us sharper implication of the effects of agency frictions on equilibrium prices, which is ultimately what we want to understand and we want to study. In fact, we microfound explicitly the agency friction, the moral hazard problem, and we will be able, by simply changing the intensity of these frictions, understand the impact on prices through the endogenous contract. The second advantage of endogenizing contract in a general equilibrium setting is that we can say something about the efficiency of this contract by comparing them with social optimal contracts. Now, let me give you a preview of the result before introducing the model. So what we show is that the presence of agency frictions, benchmarking will be part of an optimal contract. And in particular, benchmarking will be used to restore the incentive of the manager to take risk. Now, with benchmarking, now managers will be obviously less willing to deviate from the benchmark. They have an incentive to distort their the investment portfolios, and this will have an impact on asset prices. So let me highlight the main result in that respect. We show that agency friction through optimal benchmarking exacerbate the price distortion at the asset level. So what this means that undervalued asset in equilibrium will be even more undervalued, and overvalued asset will be more overvalued. We also show that these effects, the distortion, do not cancel out in the aggregate. In fact, we highlight this asymmetric cross-sectional effect of benchmarking, whereby the positive distortion dominates the negative one. So what this means that the aggregate market overall will be overvalued. Now, agency will also have an effect on volatility of assets, and in particular, we highlight an amplification effect of benchmarking, whereby agency friction not only increase the price of these overvalued assets, but also their volatility. Now, if we put together the price distortion and the effect on volatility, the model is able to generate a negative risk-return relationship in the cross-section of asset returns. And as we know, this is consistent with empirical evidence of long-lasting asset pricing anomaly, but it's very difficult to reconcile the evidence with the basic theories of asset prices. And finally, we perform a normative analysis, and we show how private optimal contracts are not socially optimal. So let me introduce the model. So we consider a continuous time infinite horizon economy with one riskless asset that gives an exogenous return R and n risky securities. You can think of them as stocks, but even better as industry sector portfolio or even investment styles. So this is an exchange economy. So these multiple assets correspond to multiple Lucas tree, and each of these three deliver a dividend flow. So DAT represents the dividend flow per share of each of these assets, and this is given by two components, an asset-specific component and a common component. Now, the shock of these two components are assumed to follow a mean-reverting square root process. Now, all these Brownian motions are independent, and by changing the exposure to this common component, we can have a generic correlation structure among these dividends. Now, the formulation that we use of the square root process has not been explored much in this type of setting. So let me emphasize that beside tractability, we have two desirable properties. First of all, dividends here are always positive, which means that in equilibrium prices will be positive, and this is something good that we know that doesn't happen if we have constant volatility here and dividends are normally distributed. But most importantly, the volatility of dividend per share will increase with the dividend level. And this is a very natural and realistic assumption, and I will emphasize that this plays an important role for some of our results. Now, the price of an asset I is denoted by the SIT. This is an endogenous quantity, as well as the excess return per share of the asset denoted by DRIT. Now, asset I is in supply of eta I shares, which means that the vector eta collecting all these eta I shares represents the market portfolio and hence the index in our economy. Now we have a representative investor, and this investor have two ways to access the market for risky securities. The first one, he can invest directly in the index, or he can employ the manager for non-index investing. And let me emphasize here, the underlying friction is that the investor cannot directly choose asset-specific stocks, and in particular, the investor observes only fund level and not asset level quantities. Now we have a representative manager that if employed by the investor, he will choose the fund portfolio denoted by ZT and will receive in exchange a compensation contract. Now, if he's not employed by the investor, will simply invest on his own and will choose a portfolio Z bar. Now, if this was the end of our economy, this economy would be not extremely interesting, and the reason is that in equilibrium, the manager will hold the market portfolio. So in equilibrium, there would be no scope for active fund management, and the investor will simply invest in the index. So we need to introduce a scope for active fund management, and we do so by introducing a third set of investors that we call buy and hold investor. These are investors that for several reasons, for instance, corporate control reason, hedging motives, they do not hold the market portfolio. So if we believe that out there someone is not holding the market portfolio, then the manager can add value over and above the index by simply deviating from that allocation. Now, conveniently, we denote the portfolio of this investor as eta minus theta in a way that theta represents the residual supply, the effective supply that is available for trade to the investor and the manager. So in other words, now theta represents the tangency portfolio, and since it's different from the index, the manager can indeed add value over and above this index. Now, there is an agency friction. There's a moral hazard problem here, whereby the manager can take a shirking actions denoted by MT at any point in time, and this will reduce the fund return by the flow MTDT, and at the same time will deliver some private benefit that have a linear and negative quadratic component. And here, as you can see, given this assumption, the shirking action is inefficient because the private benefits are always lower than the reduction in the fund return. So what's the literal interpretation of this formulation is cash diversion. But we think about this as capturing reduced form a more general moral hazard problem whereby the manager exerts low effort to identify a better, more efficient portfolio. Now, the investor can influence the choice of fund portfolio and the shirking action of the manager. And you can do that through a compensation contract. So we focus on the following contract space, whereby the manager's fee, denoted by DFT, at any point in time is given by enough affine functions of two components. There are the two observables of the manager. The first one is the fund return, given by ZT DRT minus the shorting actions, and the second is the index return. In particular, the coefficients of these affine functions are taken as constant and will be chosen optimally by the investor at time 0. The first coefficient, phi here, capture the sensitivity of the manager's fee with respect to the fund return. So it captures the extent of compensation for absolute performance, whereas the second coefficient, key here, captures the concern for relative performance and hence the extent of benchmarking. The final coefficient here, psi, corresponds simply to the constant part of the contract. Now, within this class of contracts, an optimal contract will be given by the optimal choice of these three coefficients. Now, very briefly, let me show you the optimization problems of the manager and the investor. So the manager has negative exponential utility. So if it is employed by the investor, he will choose a consumption profile, the fund portfolio, and the shorting actions. And all these subject to the standard dynamic budget constraints and the compensation contract. If instead is not employed by the investor, he will simply invest on his own, will choose a personal portfolio and a consumption profile. The investor problem instead, the investor has negative exponential utility as well. Note that the coefficient of risk aversion time preference can be different. Now, if the manager is employed, then the investor will choose a compensation contract, how much to invest in the index directly, and how much to consume. And all these will be subject to the dynamic budget constraints and now to the incentive compatibility and the participation constraints of the manager. Okay? If the manager is not employed, then the investor can simply invest directly in the index and will choose a consumption profile. Now, the decision to employ the manager, as for the contract, is made at time 0. Equilibrium concept, very briefly, as we mentioned at the beginning, now prices clear the market given the contract, and contract has to be optimal given the prices. So we have this two-way feedback effect, and hence we need to solve for this fixed point problem. Let me first introduce the equilibrium without agency frictions. So if there are no frictions, then the investor will never invest directly to the index, will simply delegate the risky investment to the manager. Benchmarking will not be optimal, will not be part of the contract, so the coefficient key will be equal to 0. And the fund return will be split between the manager and the investor in a way that optimal risk sharing is implemented. Asset pricing, we can compute asset prices in closed form. They are given by an affine function of the two shocks, dividend shocks, the common component and the asset-specific components, where these coefficients are derived, again, explicitly. Now, I want here to emphasize one important aspect, which is that the residual supply, the effective supply of an asset, affect not only the price level, but also its volatility. So this generates what we call supply effects. So let me spend some time describing them. So the first one is very intuitive. Assets in small supply are going to be expensive. So this is obvious since the manager, in order to underweight this asset in equilibrium, has to earn a low expected return. However, asset in small supply will also have more volatile prices. Now, the intuition is the following. Consider a positive dividend shock. Following this positive news, expected dividend will go up and the price of the asset will go up. Now, at the same time, an increase in the dividend level will also trigger an increase in the dividend volatility. For this reason, the asset becomes riskier, and therefore the manager requires an increase in the risk premium to be compensated and to hold this in equilibrium. What this means is that the initial increase in prices will be mitigated. Now, how strong is this mitigation effect? Well, it depends on the supply of the asset. If the supply of the asset is small, then in order to induce the manager to hold a small supply, the increase in the risk premium has to be small. Whereas if the asset is in large supply, in order to induce the manager to hold in equilibrium a large supply, of course, the increase in the risk premium has to be large. So what this means is that the price of assets in small supply would be very sensitive to fundamental shocks and have more volatile. This is true also if you consider, instead of price volatility, return volatility, idiosyncratic volatility, and even return beta. Now, let's see what happens when we introduce the agency frictions. So first of all, in the presence of the frictions, the manager's fees becomes more sensitive to performance. Now, what's the intuition here? Well, now in order to discipline the manager, in order to induce effort for the manager, we need to give the manager a larger fractions of the fund return. Okay? Now, if we do so, now the manager is going to be exposed to more risk and will have an incentive to scale down the riskiness of its portfolio. This is particularly bad for risk sharing. So now the investor is exposed to too little risk. Now, to improve upon the risk sharing, the investor optimally benchmark the performance of the manager against the market index. So in Equillibrium, the coefficient chi will be positive, and the intention here is to restore the incentive of the manager to take risk. What's the problem, however? The benchmarking induces an incentive to take risk, but only index risk. Now, one can show that even in this case, the investor doesn't need to invest directly in the index, as he can change any exposure to the index through benchmarking, through the compensation contract. So we can have a look at this graphically. So here I'm plotting the absolute performance coefficient and the benchmarking coefficients against different level of the severity of the frictions captured by the importance of the private benefit. So as you can see, when the friction becomes more severe, both coefficients becomes larger. Okay? So the optimal contract induces steeper performance incentives. Now, in the next few slides, I'm going to emphasize, I'm going to discuss our asset pricing result, and I'm going to do that using some hopefully intuitive graphs. So for that purpose, I'm going to consider 6 risky assets that on purpose will be exactly identical in terms of fundamentals. So they are exactly the same, except that they differ in terms of their residual supply. So the first 3 assets are going to be in large supply. The last 3 assets are going to be in small supply. What this means is that the buy and hold investor are actually holding too little compared to the supply of the first 3, making them, if you wish, undervalued, and they're holding too much of the last 3, making them overvalued. We can solve for prices in closed form as well. So this emphasizes the tractability of the model. Now, the optimal coefficients of the prices will be affected by the contract, as is evident from these equations. And you can see how benchmarking affects this coefficient through the manager personal exposure to these assets. Now, in all these graphs, assets, the blue line correspond to assets in large supply, and the red dashed line corresponds to asset in small supply, and we're going to plot a representative asset of these 2 groups. Now let's start with the price and expected return. What you can see here immediately is that the agency friction exacerbates the supply effects on the price level. So what's the intuition of this? Well, as I mentioned, so the manager can add value over and above the index by overweighting assets in large supply and underweighted assets in small supply. But now with the optimal contract that includes steeper performance incentives and benchmarking, now the manager is less willing to deviate from the index, which means that it will demand more of the asset in small supply and will demand less of the asset in large supply. Okay? So you can see that as we increase the severity of the frictions, these exacerbate this price distortion. Now, we can look at the price volatility, and the graph shows that the agency friction also exacerbates the effect on the supply, on the volatility of these assets. In fact, assets that are in large supply becomes less volatile with the frictions. Assets that are in small supply becomes more volatile with the frictions. Now, what's the intuition here? Let's consider again a positive shocks to the dividends. As we said, this will increase the volatility of dividends, which makes the manager even more willing to be closer to the index, which means that it will demand more of the asset in small supply and will demand less of the asset in large supply. What this means is that for asset in small supply, the initial price increase due to the positive shock will be further amplified. Now we can look at the effect on the aggregate market, and we can plot the price of the market index and the expected return. As you can see, the agency frictions increase the price of the index and decrease its expected return. As I mentioned at the beginning, this is the case because the positive price distortion that we have seen will dominate the negative one. Why this is the case? Well, we now have said the asset in small supply will be very volatile. And therefore, they will account for a larger fraction of the index volatility. But what this means for the manager is that underweighting small supply asset is going to be riskier than overweighting large supply assets. So in other words, the manager prefers to capture the undervaluation compared to the overvaluations. And the consequence is that overvaluation will be left in the market. Now we can look at the asset pricing anomalies. I trust most of you are familiar with the beta and the volatility anomaly. Very briefly, in the data, we can see that stocks with high CAPM beta are on average associated with negative CAPM alpha, and stocks with low CAPM beta are on average associated with positive CAPM alpha. And very similarly for the volatility anomaly, if you take stocks with high volatility or a high idiosyncratic volatility, they tend to have low expected return and negative alpha. And of course, vice versa. So what we can do now, we can look at these quantities within our model. And what we can plot the CAPM alpha, the CAPM beta, the return volatility, and you can immediately see how the severity of the friction will exacerbate a negative relationship between risk and return. So when the friction is high, CAPM beta is high, volatility is high, and that asset earns a negative CAPM alpha. What's the intuition? So by now it should be clearer. Stocks in small supply, the overvalued stocks, have a low expected returns, are expensive, so they have negative alpha. We show they have high volatility, and therefore they account for a large fraction of the market movements, which means that in equilibrium they will have high beta. So here, basically, our model is able to generate the frictions using a novel mechanism that emphasizes the importance of agency frictions in the context of delegated portfolio management. Now, in the last few minutes, I'm going to discuss our normative analysis. As I mentioned, because we endogenize contract in a general equilibrium setting, we can finally say something about the efficiency of this contract. So how do we do that? Well, we compute the social optimal contract by solving the social planner problem. What is the problem here? The social planner chooses the contract within the same contract space as the investor, and will try to maximize the investor utility subject to the incentive compatibility and the participation constraints of the manager. Now, what's the difference compared to the problem of the investor is that the social planner is able to internalize the feedback effect between contracts and prices. So what we show is the private optimal contracts are not socially optimal. And in particular, under the social optimal contract, we can show that the compensation for the manager is more sensitive to performance. So both the coefficient for absolute and relative performance will be higher under the social optimal contract. So what's the intuition here? Now, when the private investor is structuring the optimal contract, is taken into account that by inducing steeper performance incentive, it will induce the manager to distort the portfolio allocations and to invest in something that will be very close to the index and hence to leave more mispricing on the market. Now, therefore, there's a trade-off between incentivizing the manager for effort to reduce the shorting behavior and capturing the mispricing in the market. Now, this trade-off is absent under the social planner perspective, and the reason is the following. The planner internalize that by increasing the incentive for effort. This will not affect the incentive to capture the misvaluation in the market, because in equilibrium, prices has to adjust, and hence mispricing will increase precisely to induce the manager to capture them, and hence to hold the residual supply available in the market. So in other words, the social planner is in a better position to incentivize the manager to reduce the short-term behavior. All right, so I'm going to conclude here. So in this paper, we studied the joint determination of asset management contracts and equilibrium prices. We highlight new asset pricing result. We can rationalize the negative risk-return relationship in the cross-sections. Benchmarking, optimal benchmarking has an amplification effect on volatility, and the price distortion at the asset level will not cancel out in the aggregate, making the market, the aggregate market, more prone to asset bubbles. And finally, going forward, we think that this study can open the door for public policies analysis of this industry. And for instance, some interesting questions going forward would be how to whether asset management industry could be systemic because of these contracting features despite the absence of leverage. And more generally, we should try to think of in a different way on how to optimally design the contracts and the benchmark that we have in this industry. Thank you.